So can you tell us a little bit, for someone like me that doesn't know anything about this for the most part, other than what Tyler's told me, can you tell us your backstory or how you got into this? What made you interested?
Yeah, 100%. And thanks for having me on, you guys. It can be fun. So I got started in the world of funds. And for people that don't even know what we're talking about, a fund is essentially just a pool of money. Investors put money into that pool, and then us as fund managers can draw from that pool and go make investments. Like that's when I say, like, that's a very broad definition. There's syndications. We can talk about that and different types of funds, but that's like the most broad definition. It's like one of the oldest business vehicles in the world, right? Is this. And so it's been fun I've gone on and launched 2 funds now. We're launching 2 more funds. We have a real estate fund and a crypto fund coming out, which should be kind of fun. But sorry. And by the way, I'll hop into the story, but feel free to interrupt me whenever, ask questions, whatever. Feel free. Don't let me go too long. But I was like a lot of people. I got into college. I was super ambitious. I grew up in a pretty regular household, and I was like, okay, it's time to make some money. Like, I'm here. My goal is to make money. So my first 2 years of college, I started 6 different businesses. I did Chinese tutoring. I wholesaled 2 houses. We did website design. We sold chocolates online. We did drop shipping. And we did all sorts of stuff, Forex trading. I mean, like everything. And these weren't like business ideas. These were actual businesses that we were like up and running with. Anyways, my dad grabs me, he goes, Bridger, you're kind of like a chicken with your head cut off. I want you to go meet with one of my business partners. Like, I think this guy can help you out. And I was like, okay, I'm 21 at the time. I'm like, all right, whatever. I'll go meet with this guy. And so I put the address in my phone. I drive to this guy's house and I pull up into this gated community. I'm like, it's a pretty nice area. And again, my dad drove a car with 300,000 miles on it. I mean, we lived it was a nice home. I always had food on the table, but it wasn't anything fancy by any means. And I'm like pulling this neighborhood. I'm like, holy crap. And I start seeing these huge houses drive by, and I finally pull up around this hill to this gorgeous white mansion that like kind of encompassed the cul-de-sac. I was like, holy crap. Like, who's my dad's business partner? This guy's insane. And I, get out of my car, I go knock on the door, and I'm a little nervous, like, a butler's going to come and like, be gone, peasant, like, get out of here kind of a thing. And anyway, I knock on this guy's door. He comes to the door, goes, Bridger, come on in. I'm like, hey, you're great. We walk in. There's the wine cellar, the grand piano. He's got the pool in the backyard, the cars, the basketball court in the basement, like the whole thing, right? Come in. I sit down on his big couch, and I kind of slump in, and we start to chat. And we start talking about business, life, career, all that kind of stuff. And finally, I ask him, I go, how did you get all of this? Like, how did you do this? Like, what's the story? And he goes, what's funny? He goes, Bridger, it's not a lot of people ask me that question. And I was like, oh, shoot, sorry. I don't know if I like offended you or something, but like, that's the one question I had was like, how did you do it? And how can I do it as well? And he goes, well, let me tell you. And he goes, when I was in my 20s, he goes, I started a number of businesses. I actually had moderate success. I was doing real estate transactions. We had another business. We did pretty well. But he goes, then I figured out the secret of the ultra wealthy. He goes, the ultra wealthy families of the world and people that he knew in his realm, and these families would send their kids to the best universities. They'd try to get them into investment banking or consulting. Sometimes they'd cheat to get them in as well. We've seen that on the news as well, right? And then they eventually, though, the goal for those kids was to work in hedge funds, private equity, or come back home and run the family office. And he goes, I met a gentleman. He was a young guy. He ran a private equity fund. He was one of the wealthiest people I'd ever met. Like, not like fake wealthy, but like truly wealthy. And he said, at that moment, he said, I don't care how long it takes me. I don't care if it takes me 1 year, 5 years, or 20 years. I was going to figure out what a fund was, how to start one, and how to scale one. And so he's like, that's what we did. And he goes, we launched a real estate fund where we'd go buy primarily multifamily, a bunch of other asset classes. And he goes, at the time, they were managing just over $8 billion of real estate. To put that in perspective, I know probably a lot of your listeners follow Grant Cardone Capital. That's 4 times bigger than Cardone Capital is today. And this was, I don't know, 5-6 years ago. Today, now they're over, Deca $20 billion fund. It's crazy how big they've grown. And I was just blown away, right? I'm in this guy's house, I'm like, wow. And I've always heard from people like you guys on, podcasts and stuff, find mentors, right? You always hear that. Find a mentor, they'll teach you everything. So I'm like, hey, do you want to be my mentor? I'd love to learn from you. Young college kid. I'll work hard, I promise. Like, and he goes, Bridger. He goes, go talk to your dad. Your dad knows about this way more than I do. And I said, no, my dad's poor. Like, he drives a crap car. Like, I want to learn from you. And he goes, Bridger, I'm sorry to break it to you, but me and your dad actually make about the same amount of money. And my chin about dropped to the floor. I was like, huh? Come again? Like, what? He goes, yeah, I mean, me and your dad are pretty much equal business partners in this thing. I left the dude's house. I drove straight to my dad's house. I was like, Dad, what the heck? Like, what's going on? Like, why haven't I been able to order a soda at Chipotle for the past 5 years? Because it's too expensive. And yet you're managing billions of dollars of real estate. And anyways, he kind of laughs. To make a long story short, he laughs and I start to sit down and I said, Dad, why don't you teach me this stuff? And so he sat down, we pulled a whiteboard out, he started to teach me about investment funds, how general partners and limited partnerships work, what an Lpa PPM was, how different registered investment advisors work, different licenses, all this kind of stuff of the whole fund world of high finance. And I was blown away. And I was, I'm 22 at the time. I was working I'm in college. I'm working at a startup. And at like this, I just got hired as an intern at the startup. And what's funny is when you guys know this, when you learn something, you start to see that thing in your life, right? Like if you ever gone to try to buy a new car, like you go buy a new, Mercedes or an Audi or something, all of a sudden you start to see that car everywhere, right? And you see the same color of that car. It's the same thing for me about funds. The moment I learned about funds, I started to see opportunities of where a fund could start. So anyways, I'm at this business and I saw this opportunity that there was clients coming through this business. We could lend money to them, do these short-term bridge type of loans. They were 30 days. They were small loans, like $1,000 to maybe $8,000 a loan, really quick, high turn loans. I was like, man, we could do this. I talked to the founders of the company. They loved the idea. And I went and talked to my dad. He loved the idea. We put this whole fund together. I was so excited. We put the whole thing together. And then I hit this wall. Crap. Now I've got to raise money. And for whatever reason, I overlooked this. And that's like the core, like of any fund, like that's the core thing you need is money, right? Like that's the first thing you're thinking about. I don't, for whatever reason, I didn't think about it. But then I had this great idea. I thought, aha, my dad is rich and doesn't spend his money. He likes to invest. He likes to save. He would probably love to invest in my fund. And so I went to my dad. I remember it was a late Sunday night and I walked into his home office and he's sitting there working on something. And I walked in and I said, Dad, I want to thank you so much for, helping me structure my fund. And he really did. He helped me think through it and mentor me. And I said, Dad, I know you like the idea. And in my best pitch voice possible, I said, Dad, how would you like to be our first investor into our fund? And kind of like my hand with that too, like the whole thing, like, how would you like to be in our fund? Right. And he kind of laughed and smiled and he said, Bridger, he goes, I have the money to invest. But if I invest in your fund, I would ruin the experience of you raising money on your own. He goes, your first investor is your hardest investor to find. And if I do this for you, it'll be a crutch that you'll never be able to recover from. And he said, no. And it was a big, tough love moment between me and my dad. And he kicked me out of his little home office and I walked out with my tail between my legs and I didn't know what I was going to do. And I decided that night, I said, you know what? I'm going to prove it to him. I'm going to take him up on the challenge. And I went out and I talked to everybody I knew. I'm sorry, you guys have done that before, but I talked to former bosses, college professors, family, whoever it was. And after about 4 weeks of pitching, I raised a whopping $49,000 for our first little micro fund, which is just teeny, right? You guys know that's a teeny amount of money. But it was enough to get started. And I was stoked. I was so excited. And we started this little micro syndication fund. Our first group of investors, we were turning these loans. We got them a 64% return on their money, which was awesome. Small amount of money, but good returns, right? And so we closed that little syndicate down. And then we launched our second fund. That fund, we actually grew pretty rapidly. We raised and deployed millions of dollars out of that fund. We did really well. I ran that for about 2.5 years. We just sold that fund to a competitor about 6 months ago.
What were you
out
in?
and we exited a fund. And then now I'm launching 2 more funds right now. So we have a crypto fund coming out. We've soft raised about 12 million for that. We have another real estate fund coming out. We've soft raised about 75 million for that one right now, both coming out at the beginning of the new year. So, and then go ahead.
What was the one you sold? What kind of fund was that?
Same model. It was the same, those small term loans, those 30 to 60 day short term kind of bridge loans. Same model. Okay. It was the same one as the first one, but we just restructured it into a full out fund model.
Okay.
So anyways, it was fun. And then with all that, sorry, and then I'll shut up. You guys can talk.
You're good.
During that journey, we had a lot of people come and ask me and my brother. And by the way, my brother is a securities attorney. So he does law for funds. So he's actually, now he's an attorney at the largest law firm in the world. They charge clients $2 billion a year to set up funds, which is just insane. I think it's $2,000 an hour to work. Anyways, crazy. He formerly was a chief legal officer and compliance officer at a $700 million fund. Anyways, so we've had a lot of people ask myself, my dad, and my brother, how do you start funds? And all of us did it without Wall Street. None of us did it with Ivy League degrees. And so anyways, that's why I started the podcast and YouTube channels, which you guys saw me on, to just help more people understand this world of funds. It's crazy. No one talks about this online. No one shares information. It's like this secret black box of this high finance world that you can only learn on Wall Street. And actually, we have a lot of Wall Street people we work with that still don't know how funds actually operate and how to start one, how to scale one, how to raise capital, how to build them, the whole 9 yards. So that's why we started Investment Fund Secrets. And that's why we do this kind of stuff. It's just honestly to help bring this to the masses, to help more people understand this incredible model. And it's been cool to work with. We have one group right now. They've raised $900 million in the last 18 months. They were zero. We have two funds about over 100 million each. We've got a dozen plus funds over 10 million. And they're everything from venture capital to private equity to real estate to debt to crypto to the crazy, buying almond farms to buying Hollywood scripts. I mean, the whole 9 yards. So it's fun. We have a lot of cool people. So anyways, I'm going to shut up now. We'll get back to it. But that's kind of my story of how we got into it.
No, you're good. That's a good point, because I feel like for me, like he's all interested in it, so he's done the research and everything. But like hearing the general, like just people talk about funds, it's like intimidating. So it's not something you think it's like, oh, this big difficult like high money thing. You got to be part of the high dollar club, I guess, to get in it. But it's really sounds a lot more simple than that.
Did you make it? Because you had like a pretty good corner that in your corner when you were starting out. Did you make any mistakes really starting out? Even though you or did you just ask your mentors like before you made a step almost?
Yeah, I definitely made some mistakes, but a lot less, because I had mentors, right, to show me the path. And the other thing too is a lot faster. A lot of people try to start funds. It takes them 3, 4, 5 years to figure it out. I was able to do it in a couple months because of mentors, right? One mistake though was our first structure of it was actually a syndication. And we can talk through real estate syndication. I'm sure a lot of people listening do that, right? Where you syndicate. If people aren't aware, like it's a syndication, obviously it's a very broad definition, but typically you have a project, like you have a house flip, like you're going to flip a house. You go, use your own money, family money, friends, fools, bank money, or hard money typically, right? Or a line of credit that you'll pull in. You flip the house and you syndicate, you create an LLC for that one house, you go flip it, right? That'd be a syndication. And it's actually funny, as a side note, which is, by the way, a great way to build a track record of syndications. We had a guy we worked with, he was flipping about 2 to 4 houses a year, which is actually a good amount of houses. He'd done them for a few years. We helped him launch a fund, and this year he's flipped 72 houses out of that. Oh, wow. Which is cool. And all it is, it's just scalability, right? You just get a bigger pool of money that you can pull from. You can transact faster. You don't have to call investors at the 9th hour to try to get money in. So, but anyways, back to, a mistake. We set up a syndication at the beginning, which was fine to get started. But the way we set it up was we had an LLC. All the 7 investors we had, all were partners on the business with me. And meaning they had signing accounts and they could open bank accounts and all that, right? Because they're truly our partners. And we had one partner set up. He had bank accounts that were, and I let's see, he had separate bank accounts. I was the guy running the business, how the money in and out. And one day I saw $11,000 was missing from our fund. And that's a 20% of our portfolio, right? We only had 50 grand, you know what I mean? It's a big chunk. And I was like, oh my gosh. And I'm looking at the bank statements, and we had a lot of transactions because we're doing these small little loans. So tons of transactions. I'm like, what? This must be a mistake. Anyways, after 2 days, I called the guy. I'm like, what's going on? He's like, oh, let me see, blah, blah, blah. Anyways, he gets back to me a day later. He's like, oh yeah. I was just pulling out my investment. I have to make payroll in my other company. And so I just pulled out my investment. Jeez. And I'm like, you can't just pull out your investment. Well, Neil goes, well, sure I can. I'm an investor. I go, no, you can't. There's documents here that say you have to give us 60-day notice, and it's my decision if you can pull your money out. And he goes, well, it's not a big deal. And I goes, it is a big deal. In the legal terminology, it's called fraud, what you just committed, right? And he's like, oh shoot, blah, blah, blah. He's like, I'm like, well, just, it's no worries, put the money back. He goes, well, I can't do that because my business is kind of, really rocky and I need that money. We just made payroll last week. We might not make payroll this week. We're kind of going downhill. And I was like, oh my gosh, right? Shoot. And that, which is still okay because it's just his initial investment, right? No big deal. But also it hurts all the other investors that are in the deal, right? Those 6 other investors that were in the deal, their money now is more at risk than his. And we need to rebalance the fund. And there's loans outstanding that might default, right? And he just pulls his cash off the table. It opens up quite, and that's why you don't allow that to happen. But syndications, that can happen, right? Where partners can kind of elbow you around. Anyways, I can go more into that story, but that's one of the reasons we closed that fund. And actually, it actually ended up turning out fine. We had loans come to fruition and we worked it out over the next 3 months. But still, that's why we moved to a fund model. So we moved to a fund where I was the general partner. All my investors were limited partners. They have no control, no say, for the reason of protecting them against each other, protecting them against if they got divorced, their ex-husband or wife is suing the syndicate, right? And if they wanted to move stuff out, there's so many benefits to running a fund. That's why, by the way, most people, that successful people in finance end up running a fund one day, just because of the protection it gives you when running it.
So when you made the mistake the first time of setting it up, did you set it up like almost like an LLC and you own like a portion of the LLC? How did you make that mistake and how did you set that up? And
we set it up
differently.
I believe I owned 30% of the LLC. My other investors shared the other 70% pro rata how much money they contributed. That's how we set it up.
Oh, okay.
So, which was fine. But the other problem was we were like, they wanted to half manage it with me and half not manage it with me. And so they were on bank accounts or on other signing things as a checks and balances, but they weren't full time on it. And that was the problem for that.
Yeah. Because I heard like when people syndicate like that, they can technically, I guess all the investors can kind of get together and can't they like push you out of your own syndication? Or is that a thing?
Oh, 100%. Like, yeah, 100%. That happens all the time. And again, syndications that's a broad term. There's a lot of ways to set them up, but the scary part of syndications is, your investors can get together. They can boot you out. They can vote you out. They can sue if one investor didn't pay their taxes last year. Let's say your biggest investor forgot to pay their taxes, right? They call you up, Bridger. Hey, I know this is a bad time, but I didn't pay. I owe $4 million in taxes right now. And can you sell the properties early so I can get paid out? Even though they're not ready, can you sell them? And in a syndicate, you kind of like, you're like, yeah, I mean, we kind of have to, like in a fund, you go, no, I'm sorry. My fiduciary responsibility is to the fund, not to individual investors. And this guy will, no, but I'm your biggest investor, blah, blah. You go, so sorry, tough, that's kind of one of the biggest. Have you guys seen the movie, The Big Short?
Yeah.
You guys seen the movie? There's a great scene in there. Michael Burry, he's played by Christian Bale. He's got the kind of the glass eyes, like the autistic kind of guy. There's a great scene that like epitomizes this is one of his biggest investors walks into his office and their fund is down like 27%. And they're trying to short the market, right? And they're paying these premiums to keep their short position open. And he walks in and says, he goes, Michael, give me my money back. Like, give me my money out of here. And Michael just goes, no, the market's going to crash. We're going to pay out. And he goes, no, get out of my office. Like that epitome. And again, you don't want that conflict with investors, but it does come up when you're managing, a couple hundred investors' money. Someone's going to get sued. Someone's going to go through a divorce. Someone's going to have a bankruptcy on the other side. And if in a syndication, they can really rattle a syndication. In a fund, it's 100% clean. There's no problem. It protects both parties way better.
Okay. So you can set up like a syndication as a GP and LP where they can't really contradict each other, or they can't have no, I guess, say in like pushing you out or anything like that.
Yeah. So you can set up a syndication that's, a form, you file a Form D, you can do a 506B or C if you want on it. Yeah. Typically though, my change of definition is typically those are for a deal by deal basis. So this is the other pros and cons of syndications versus funds. Let's say you found a great property, it's 30 units, you're going to file a Reg D and, raise for that, which would protect you 100%. And that's a great way to do it. And actually a great way to build a track record. However, not the problem, but if you want to scale and do more of these properties, just like that, every time you do a new property, what do you got to do? You got to set up, you got to file another Form D. You got to call up your investors. Hey, we got a new property. Let's put money into this new one. Right. And it's a little monotonous and actually slows you down. One of my mentors, they run a multi-billion-dollar fund, real estate fund. And he was telling me, he goes, Bridger, we actually, two benefits. He goes, we win deals when we're not the highest bidder often. We're usually the second or third highest bidder, but we still win the deal. And these are $100 million deals that they're doing. He goes, because let's say it's $100 million apartment complex. We're bidding on it. And this other guy bids. He says, hey, we're going to bid. We're going to syndicate. We give us, 60 days. We got to get the money together and get all the financing, all that kind of stuff. And they go, we step in with our fund. We say, hey, we'll close at $94 million. However, we have proof of funds right now and we'll close in 14 days, right? Winning a deal isn't just about money. It's about terms. And he goes, oftentimes we will win a deal for $6 million cheaper just because we have a structure behind us. Is that kind of making sense? Same thing with like even single family house flippers, right? Oh, I found a great house. I'm going to lock it up and then I'm going to try to raise money and get the money together and try to close on time. It's like our other guy that flipped 72 houses this year. He goes to the courthouse, cashier's check in hand, proof of funds is there. Hey, I can close tomorrow on this house. Yeah, you can wait 40 days for this guy to get his financing together, or you can close with me tomorrow. Who are you going to pick? And you win more deals, you get more speed, you get economies of scale. Again, back to what I said, syndicates are great, but if you want to scale, that's the reason most people that are successful in finance end up in the fund model, is for those reasons. Yeah.
So speaking of the fund model, is there actually any like a different type of different kind of funds? Like I know there's like a 506B, 506C, and so on. What are the differences between those?
Yeah, so we can start with those two. There's actually a bunch more too we can talk about as well. There's Reg CF, which is regulation crowdfunding. Reg A, which does like it's a hybrid of crowdfunding and other fund. Those are probably the most popular ones. But you hit it right in the head. So Regulation D 506B, B as in boy, and then there's Regulation D 506C, like as cat. A 506B, just kind of get in the weeds if you guys want to learn it. A 506B is the most common fund in the world. 99% of all capital in the world, I mean, I'm talking trillions of dollars, goes through that little filing. Regulation D 506B is what it's called. And it's crazy how much money, I mean, these huge hedge funds, private, I mean, hundreds of billions of dollars, that's how they all file right through there. The rules behind that, number one, is you cannot publicly advertise your fund. This is again for a B as in boy. You can't advertise your fund. This is the reason you don't see advertisements for KKR, BlackRock, Blackstone. I mean, that's the reason you don't see ads or commercials. It's against the law for them to advertise. The other rule is the type investors, and then there's sub filings. There's called a 3C1, a 3C5, 3C7, which we won't get into the weeds of that, but there's different rules on who you can raise from, whether it's an accredited investor or a qualified purchaser or a qualified client, something like that. We can talk about that.
Like accredited investors, like a person with $1 million net worth, someone who makes $200,000 a year, and then jointly they can make $300,000 a year.
Yep. Right? Yeah, exactly. Did you know there's 2 tiers above that?
Yeah. It's the qualified buyer and the qualified client. One's 2.1 and the other one's 5, right?
Yep. Yeah. Qualified purchaser. So qualified purchaser is 5 million, qualified clients 2.1.
I think we'll probably get into this later, but certain funds like accredited investors, they can only charge like a management fee, right? And qualified buyers and clients can do both, like a performance based and a management fee, right?
Yeah. So it depends. Again, it always comes back. It depends. That's the general rule, though. Yeah, it's a great way to look at it. That's if you're at the SEC level. So it's kind of interesting with funds. You're not in the SEC or at the state level. It depends on how big you are. So if the $150 million mark is the mark, $150 million. If you're below $150 million, you fall under the state of which you're primarily domiciled in or do business in. If you go over $150 million, you're in the SEC. So what you just said is correct at the SEC level. That if you're going to charge both fees, management fees and performance fees, they typically, again, there's a few exemptions, but typically need to be qualified clients or qualified purchasers. At the state level, though, if you're under $150 million, there's a lot of exemptions. So you can run your fund and charge both fees. It just depends on every state's a little bit different. I'm in Utah. Utah has certain laws for real estate funds versus crypto funds versus hedge funds. So yeah, it just depends. But yeah, good point.
So when you first started your fund, was it hard to meet people that met that threshold that can actually invest with you? Because I know a lot of people, like even like my age, there's really not that many people like already have $2 million net worth minus their home. So
yeah, it's a good question, right? It's like, how do I find these people, right? Like, it's even harder to raise money because they got to hit this net worth criteria, right? And by the way, there are 2 other ways you can raise without a high net worth. It's a Reg CF or Reg A. We can talk about those more, but there's a lot of ways. Back to the fundraising question there's a lot of ways to raise capital. Number one, the first thing though is your mindset. And I know it sounds corny and dumb. A lot of people say what you just said to me. Bridger, I don't know anybody with money. I know there's no money out there. Everyone's broke. And it's like, that's a complete lie. There are so many people with money. You wouldn't even believe it. And you can't even believe how many people have money. They don't show it off. They drive a Ford F-150. They live in a regular house and they have $8, $10, $20 million tucked away. I know a lot of these people. My dad was one of them, right? Yeah. My dad had millions of dollars. He's the millionaire story. There are way more of those types of people than there are the flashy Instagram Lamborghini guy. Like, and I think a lot of us see Instagram, we go, oh, if you don't have an Instagram on Lamborghini, you're obviously not rich. And it's like, that's just not true. Like, you guys know that, especially real estate people. Like, there's a guy with a mustard stain on his shirt, like every day, and he has like 20 million in real estate. You know what I mean? So there's number one is mindset. The money's out there, but let's get more to tactics, right? Like, what are some tactics to like find these people? This is kind of how I break it up is either work your way. There's 2 kind of categories, work your way in or buy your way in. So that's how I think about getting in front of these, high net worth individuals. I can either work my way in or can buy my way in. Working my way in, I'll start there. Working my way in would be, again, work, right? You're going to real estate investor meetup groups. You're going to entrepreneur groups. You're going to, on LinkedIn, you're doing due diligence, trying to send messages. I mean, it takes a lot of work, right? You're trying to network your way in to these groups, angel groups. Now, the other side, so before I go on, these people they're looking for you. They are looking for your investment. There are groups that get together twice a month of really high net worth people and they get together hoping that good investments come to the table and talk to them. Like there's not like these they are trying to find good investments always, right? And so, anyway, sorry, back to the structure. I'm getting on tangents, but work your way in, buy your way in. That's kind of working your way in. The other way is to buy your way in. I personally like doing a hybrid of both. Buying your way in would be an example. One example, one of my mentors, when they were raising their first money for their fund, they actually rented out box seats to the Utah Jazz game. It was like $45,000 a year. And it's a startup company. And my one mentor was like, what the freak? Like, my business partner bought this thing. Like, are we just blowing our cash? Like, what's going on? Like, we're already in debt. And he goes, hold on. Don't freak out. It's going to work out. And he goes, it better work out. Cause like, we're going to lose all this money. He goes, when we call into a successful CEO, right? They have a gatekeeper, and that gatekeeper is told, hey, they're busy. They're in a meeting. We can't talk to you right now. If you call that same gatekeeper though, and say, hey, hi, this is Bridger calling in. I was looking for Mrs. Johnson. Mrs. Johnson, we have 2 tickets tonight. The Lakers are coming into town. We have box seats. We'd love for Mrs. Johnson and her husband to come with us to the game. And my name is Bridger Pennington. We have a fund, and that's what we're doing. 9 times out of 10, that secretary or assistant's going to pass that message on. And that's how they raised $75 million just from that strategy alone. That's buying your way in. I'm in a mastermind right now. It's $30,000 a year to join. I'm in another one that's $20,000 a year. I've joined both of them this year. You get it. It's pay to play networking. I bought a supercar recently. I like cars. I like racing. I love going to the track actually, but guess what? Guess who's also at the track with their Ferraris and Lambos? Everybody that I want to invest in my fund, right? Guess who goes on drives together and meets up like supercar people? The people that I want to meet, right? That's buying your way in. So there's, those 2 categories, and there was a lot of ways to think about it. The other thing I tell people though is this: if you're not naturally like outgoing and that natural salesman and naturally already have connections, there are plenty of people who have them. I love, you guys have probably heard this before, but you got to change the question. Don't ask the question, how do I raise money? Change it to who can I find that can help me raise money? Yeah. I had a guy call me last year. He goes, Bridger, I have 2 friends that are both billionaires, and I've been helping them find deals and stuff, but they want to invest into projects that are like my own, that I'm like on it. Cause they were friends. They want to invest in me. Hey, Bridger, can I partner with you on your fund? Like be a small partner, but I'll bring these 2 billionaires with me. And I'm a good networker. I can bring a lot of other people. And I'm like, you got 2 billionaires that want to invest with us? He's like, yeah. And I'm like, yeah, I mean, come on in. Like, yeah, let's do it. Yeah. Great. Like, that sounds awesome. There are plenty of people. Like, if you go to broker dealers, registered investment advisors, money man, like these, those investment advisor people that call you up, their full-time job for the last decade has been to meet these people in group. So if you're already good at real estate, don't try to reinvent the wheel and try to be really good at fundraising. Find a partner. Change your hows to who's, right? Anyways, that's something else. I can go on this for another hour if you want me to, but I talk about like getting in the room, how to close that person, how to move them. Anyways, we talk about all that. I have a 3-step formula to raising capital. But anyways, hopefully that kind of gives you a framework to work from.
So kind of get back to like almost like you said, I guess technically the little guy, you said there's two like type of funds that you can do that don't require accredited investors.
Yes, what are those? Yeah. So you see like Grant Cardone's a great example, right? He raises like $1,000, $5,000 from non-accredited investors, right? The two main strategies that people use right now are called Regulation CF, stands for Regulation Crowdfunding, or Regulation A or A+. Both of those structures allow you to raise money from non-accredited investors. If you see Fundrise is on Instagram all the time, I see a Fundrise, right? That's an example. They run Reg CFs or Reg A's. You can publicly advertise and you can raise money from whoever. Now, just in general, it's kind of a general rule the SEC kind of has. The reason they have those benchmarks, in my opinion, is the SEC is designed to protect the little guy. They don't want a slick talking fund manager like Tyler, Emily, or me to come along and say, hey, grandma, give us your last $20,000 of savings. We're going to invest in this great deal. And then we lose all their money. And now grandma can't live anymore. Right. That's where the SEC gets really mad. If you go, you raise, 500 grand from a multimillionaire, billionaire, and you lose their money. Okay, fine. That person should be sophisticated enough to know what to invest into. Is that kind of making sense? So anytime, just as a rule of thumb, anytime you raise money from non-accredited investors, you have to over disclose to these investors. It's similar to running a public company. You are filing quarterly reports. You're publishing data to the street. It's all got to be actual and factual and backed and dated. And I'm trying to have appraisals on everything and audited, right? So that's kind of a rule of thumb. Now I'll walk through the differences. A Reg D, a 506B versus a Reg A or Reg CF. In a Reg A or CF, you have to pre-identify the assets. So if you ever hop onto Fundrise or Cardone Capital, they have properties already pre-identified. It's like, hey, we are raising money at this building in Charleston, and it's 100 units, and this is it. There's already a full appraisal. Here's the capital raise, right? So you have to have it pre-identified. Secondly, you cannot take more than 10% of that person's net worth or annual income. So if they're under $100 million net worth, the most you can take is 10% of their net worth, whatever that is, or annual income. So if they make 100 grand a year, the most you can take is 10 grand, right? We looked up some statistics. The average Reg CF crowdfunding investor invests, I think it's $435. The average. So the other side of the coin is, sorry, I'm rambling on. Feel free to interrupt me. But
you have to verify their net worth and I guess do the math on that. Hey, you can only put 10% in.
Yeah, they're supposed to. I can't remember if the burden is on the fund or the person, but either way, you're not supposed to take more than 10%. Yeah. Yeah. So they, anyways, yeah. And then the other side of the coin is like, if you're going to raise, let's call it $1 million. And if you're doing it at a Reg CF level, you got to raise money from, a few thousand investors who are pretty broke too, right? Yeah. Think about the phone calls you're going to get, the complaints, and then all the reports, the K1s you got to file. There's a lot of back end office that takes to do that. Versus $1 million property, you could raise that from probably 2 or 3 or 4 investors, right? A little bit easier to deal with 4 investors than 4,000, right? So what I tell people, Reg CF and Reg A are great. Make sure you have a good team set up behind you to file those K1s, those reports, to answer phone calls. I'll tell you a quick story. I raised money from a non-accredited investor on my second fund, or my first fund. I can't remember, one of the two. He gave me $5,000. And I was like, okay, cool. I'll tell you, it's a buddy of mine. And he gave it to me like on a Tuesday. Thursday afternoon, he calls me, Bridger, hey, how's the $5,000 doing? What's going on? I'm like, dude, it's good. Like, it's been 2 days. Like, it's fine. Like, we're got the fund here. Like, we're good. Cool. Okay. Sounds good. He calls me Monday morning. Hey, Bridger. Hey, I was wondering, I'm actually looking to maybe buy a house soon. Like, how soon can I get the money out, or what's going on? And I was like, what? I'm like, he's like, yeah, just what's kind of the plan? I was like, dude, I told you, like, you got to put your money in at least for a year. And he goes, okay, well, I got to make sure I can pay my mortgage and stuff. I'm like, dude, this is not for you. And I sent his $5,000 back. I said, dude, I don't want your money. This is not going to be good for either one of us. This is way too much headache already. Whoa, why are you sending my money back? I said, you are not ready for this type of investment. This is not up here. If you're worried about your mortgage and other stuff, you're calling me twice. Like, dude, no. The other investors that give me, hundreds of thousands, even millions of dollars, I hear from them once a year. Hey, here's your return. Here's your stuff. Like it's a lot easier to deal with those people because they understand how investments work. Right.
Yeah.
So anyways, that's a few notes. Again, you can do what you want. Those are fine. But the big difference is you have to pre-identify an asset versus a fund. It's a blind pool. So essentially you just say, hey, people put money into a pool. We're going to go buy properties over the next 24 months. If we want to buy a property tomorrow, we can. If we want to wait 2 weeks, we can negotiate. Like there's a lot more leeway in a blind pool Reg D fund than a Reg A or Reg CF fund. Does that kind of make sense?
Yeah, it does. I guess one question is like, so what do? Do you go and raise all the money first, or are you like, what's the steps to, I guess, complete your let's say someone wanted to create a fund, what's the steps from like start to finish, what you recommend doing?
Yeah,
like
that's a great question.
Find the deal first, raising money first.
Yeah. We kind of put it into 4 steps. We call it the fund launch formula, and I'll kind of walk you through it quickly, but it's funny. I just to give you a background on this too. I interview a lot of people on my show. I interview fund managers and all that kind of stuff and people that started funds unconventionally. And it was crazy. I started to interview all these guys that were running, guys and gals that were running hundreds of millions of dollars, even $1 billion funds. And they all used essentially the same process to launch their fund. And we kind of broke it down to 4 steps. I was like, oh man, that fit pretty much everybody. And even myself, my dad, my brother, everybody else, like these were kind of the 4 steps that we used to launch our funds. And so anyways, step 1, and this is what I asked my dad this, by the way, I'm starting my first one. I'm like, well, Dad, like, how am I going to do this? He goes, Bridger, I want to give you an example. And he goes, Bridger, I want you to imagine me and you just found a Lamborghini in Billings, Montana. And I'm like, okay. And he goes, let's say this Lamborghini appraised for $200,000, brand new Aventor. We've had a mechanical, this thing's legit. There's a lady going into bankruptcy and she wants to sell the car, like auction, sale, just fire sell it for $50,000 on Saturday morning. I was like, shoot, okay. And he goes, it's all checked out. It's all verified, like it's 100%. And we have a buyer in California that'll buy the car for $200,000, like the asking price on Monday. If we can just get the car to him, they'll buy it for $200,000, right? Simple arbitrage. You guys see this in wholesaling and houses all the time in real estate. And he goes, Bridger, here's a question to you. You can't use any of your own money. Could you find $50,000 by Saturday morning? And I kind of thought about it. I was like, huh. And he goes, you can raise from whoever, there's no lure, but could you find $50,000 by Saturday? And I kind of thought about it. I was like, maybe, I thought, former boss, a college professor, a family friend, I was like, I kind of thought about it. I was like, yeah, like maybe, I'm like, it's guaranteed. We're going to profit $150,000 by Monday morning. I'm in college. Yeah, I could do that. Like, dang, I'll stay up late. I'll probably won't sleep for 4 days, but yeah, I could find $50,000. Like, screw it. Like, I'm doing this. And he goes, that's all. He goes, what about $100,000? Could you find $100,000? And I was like, yeah, you know what? Like, it's 100% foolproof. It's guaranteed. It's like that price and everything. I was like, I'm going to net probably 20, 30, 40 grand this weekend. Like, I'm in. And he goes, why? And I go, well, because you told me the deal was so good. It was so juicy. There was so much meat on the bone. He goes, aha, there it is. And I go, what do you mean? He goes, 3 minutes ago, you were telling me you're too young, you're inexperienced, you don't have a track record, you don't have all this stuff, you don't know the right people. And all of a sudden, you're telling me you could raise $100,000 by Saturday morning. Why? Because the deal was so good. It's not a lack of resources, it's a lack of resourcefulness. And I was like, that's interesting. Right? And he said the biggest problem, he goes, like, I get pitched by people all the time. The people that can't raise money don't believe in their deal enough. They kind of raise money half-heartedly. Hey, you guys wouldn't want to invest in this, would you? I mean, it's kind of a cool deal. We're putting this together. Would you guys want to get in, or like, what's going on? Like, those people never raise money. It's the people that go to investors and say, guys, I have found the greatest investment on planet Earth. I've been looking for 20 years. I've never found something better than this. You guys want to see it? And I'm going to call you 6 times this today because it's that good. You're my best friend. You have to put money in because it's that good. When you have confidence on a deal like that, everything else changes. When you're like, oh man, I hope it works. I'm crossing my fingers this one pays out. That's a lot harder deal to raise money from. You kind of follow along. So anyways, I'll go faster. But step 1 is find an incredible deal. That's the easiest. You don't have to do this way, but the easiest way to launch a fund is by having a flagship deal saying, hey, we've got a $3.5 million apartment complex in Miami, Florida. It's appraised for $1.2 million. We can buy it by the end of the month. This is our product. Like, we're going after this, right? Now, step two, a lot of people at this point go, all right, step one, I found a great deal. Step two, let's go set up the legal documents. Let's go set up a fund. And I always go, hold on. Don't do that yet. Hold on a second. Because funds are expensive sometimes, 30, 40, 50 grand to set up. And we'll talk about that in a second. But I tell people, step two, go and frame out your fund. Get on Excel, run all the numbers, run the pro forma, run your management fees, your pref, your catch up, your carried interest, all that kind of stuff. Put it together. And then get a pitch deck together. Step three, go and pitch investors. Get in front of investors even before your legal stuff is set up. And the reason I do that is I like to go and test my investor pool if they like this deal. I found a great deal in Miami. We're going to buy this thing. It's incredible. I will go talk to mentors, people around me, and I'll say, hey, this is the deal. We're going into it, blah, blah, blah. The docs are not set up yet. They're going to be set up in a couple of weeks. But if everything checks out, and you guys are smart, you guys can look at the deal. You guys have done real estate. Look at the deal yourself. If everything checks out, can I put you down for a $500,000 soft commitment? Again, legal docs will come. You got to re-review them and stuff, but can I put you down? If it all checks out, would you put down 500 grand? And that's where the conversation begins. Because everyone will tell you, oh, you're so great, you're so nice, until you ask them for $500,000. And they go, well, okay, what's the
I don't know about that.
And then they give you stuff to improve on, right? Or they say, actually, in my experience, actually, a lot of those investors said, yeah, you know what? If everything checked out, if it was legit, we had this, whatever X, Y, and Z that I need, yeah, I would probably put, $500,000 or $250,000 or $100,000 into that. And I said, great. I'll put you on my list. I'll reach out to you about in 2 weeks. And what I will do, I will try to soft raise about a quarter to half of the deal size, if I can, of the fund before. And sometimes I go do that and it's crickets. Investors hate the idea. And I'm like, oh man, well, I thought it was a good idea. I guess I'm happy I didn't go spend 50 grand on documents for something that no one wants. So the way we help our students and all of our people launch their funds, the moment they start documents, they've already got $12 million ready to go into their fund. Well, I just mentioned to you a second ago, we have $12 million, exactly $12 million raised, soft raised for a crypto fund, another $75 million for a real estate fund right now. Soft raised. That's happened over the last 30 days. We've been talking to people, trying to feel them out. Okay, we've got enough money that we feel like this is legit. We've gone to now step 4. So step 1, find a deal. 2, frame it out. 3, go soft raise. Step 4, then do your legal, right? Go hire the lawyer, all that kind of stuff. And then the last thing I'll say with legal, just as a tip, you don't want your lawyer to also be your teacher. You don't want, because it's an expensive teacher. You don't want to walk into a lawyer's office and go, hey, I want to do a fund. Can you teach me about funds? Because a lawyer will say, oh yeah, we'd love to teach you about funds. Come sit down for $700 an hour, and I will slowly explain to you how Lpa and Ppm work and management, all this stuff, right? So when I go set up a fund, like this law firm we work with, it's usually 30 to 35 grand a fund. I walked in there, it was 12 grand for my fund. Why? Because I walk in and I go, hey, I want XYZ with a drink and a side of fries. I know what I want. I know funds really well. This is what I need. And they go set it up for me. And then after step 4, I'll go back and talk to my investors, get that money in, and move on from there. So hopefully that was kind of a crash course on the fund launch formula. But anyways, that's kind of the steps that we've used. We've helped a lot of people launch their funds that way, and it's been a really successful route to go. And by the way, if you get to you have a great deal in step 1, you framed it out by step 2, and sometimes deals fall apart 20 days later. They just don't happen. And that's okay. You didn't waste any money. You didn't really waste any contacts. All you wasted was a little bit of time, and that's okay, right? And you kind of work through this process. I've had a lot of funds fail. Not funds fail. I mean, I never launched them, right? Because I had 3 funds last year. I was going to launch, I was going to get them ready, and investors just didn't like it, or we didn't have the right deal, or we didn't have the right thing, right? And so it's okay. You don't waste money. I think too many people get burnt out. If you go read blogs about launching a fund, they'll tell you, oh, it's so expensive or it's so hard. Yeah, it's hard if day 1 you go pay a lawyer 45 grand to set up a fund and then you don't raise any money. Yeah, that sucks, right? So anyways, sorry, I'm going too long.
No, you're good. You just mentioned a couple minutes ago, like the Lpa and Ppm.
Yeah.
For people who don't know that, can you explain what those 2 documents are?
Yeah, so an Lpa and Ppm stand for Limited Partnership Agreement, Lpa, and then the other one is Ppm or POM, Private Placement Memorandum or Private Offering Memorandum. These 2 documents are thick. They're usually 100 pages each. And they are I like to call them the Bible. These are all the laws, bylaws, covenants of your fund, all the rules, everything of your fund. The coolest thing about funds is you get to write the Bible. You get to write pretty much all the rules of your fund. Now, once it's written, you got to follow it. But you can decide. If you're like, hey, our fund minimum commitment's $100,000 to our fund, you write that in your little like PPM. And then you'll probably add a subclause unless the general partner or managers decide to waive that. And you write that in. And so if somebody wants to come with you $50,000, cool, I'm a general partner, I can waive that, right? Hey, we're going to invest into, we have one guy that does funeral homes in our group. Cool, you write that in your thing, right? We're going to buy and sell funeral homes. Like we're going to do it in this state. We're going to do it with this way. We're going to pay investors, we're going to charge investors a 5% fee and charge them 50%, whatever you want to do. You write that in your documents and you get to write all the rules of your fund, which is pretty cool. And that's, by the way, that's why lawyers are so expensive. And it's a lot of documents to write and go through. Typically why it's expensive to go through. And again, if you know your stuff though, typically I will ask for discounts from lawyers and I usually get them. So a lot of my funds are 10 to 15 grand and the fund can reimburse you for those setup costs. So if you spend 15 grand on a fund, your fund after it's set up can reimburse you. It's a startup cost of the fund. Just a side note.
Yeah, I think you said on your YouTube channel, you said that one tip is just to reread those documents like over and over and over and over again. So unless you know everything in there. So then when you went to the lawyer, you know everything that you like more or less back and forth.
Yeah, so. I did that originally. That's how my dad kind of taught me about funds. He said, Bridger, I want you to read this thing. I read it 16 times. The first 10 times I didn't understand half of what I was reading. I had Google open. I was Googling stuff the whole time. We've now created courses and content and stuff to help people not have to do that because it's pretty boring and pretty monotonous to do. But I just read through this week. I've read through a bunch of LPAs and PPMs just because they're my funds. I got to understand what's in them. I got to make sure all the bylaws are correct and everything.
So if someone wanted to get those documents and just, I guess, start out just reading them, where can you find them at?
They're a little hard to find. Number one, because people don't like to share those docs because they're expensive. They don't want to just put them online. You can, if you can also Google like template examples. We have, we give a lot of our people like templates and stuff. I also get, pitched a lot of funds. So I read sometimes through other people's funds, docs or just my own stuff like that. So I got them from my dad is what I got. I read through his documents just to understand what they were saying. So,
okay. Yeah. I mean, that's smart. I guess like a kind of different note, we talked about syndications. We talked about private equity funds and funds. What would be the difference between them and like a REIT?
Yeah. So, it's a great question. So a real estate fund versus a REIT. Both are similar. Both are buying real estate. REITs have a few different rules. So a REIT is similar to a public company. Investors can invest into them at most of the time, any level. Investors can get in. REITs are pretty dedicated to cash flow. REITs have to pay out, I believe it's 90% of all rental income has to be distributed to their investors every month or every quarter whenever they're to do it. It restricts you in a lot of ways as far as creativity in your fund versus a real estate fund. A real estate fund, you could buy a C-class apartment complex. It's 20% occupied, and you renovate it, you build it up, you lease it out, you add a basketball court, you add all these amenities, all this cool stuff, and you can do a full value add play, and then sell it for a bigger profit. And a lot of times you sell it to a REIT. So they'll usually sell those because REITs just want cash flow. They're just buying cash flow, just operating companies. REITs typically aren't doing much value add. They're not managing it very well, in my opinion, because they have such a big mandate to pay out. A real estate fund has way more flexibility. And so a real estate fund can hold longer than they want. They can sell sooner if they got a good deal. They can value add. They can change it to an opportunity zone. I mean, they can do, a lot of times a lot more flexibility, and they don't have a mandate to pay out every quarter money. That's what gives them the flexibility. What's one of the big differences between a REIT and a real estate investment fund. The other thing is disclosure. So a REIT, similar again to a public company, you've got to do quarterly filings like a public company. I mean, it's a lot more filings. A fund, a lot less filing. I mean, you're writing, investor statements at the end of the quarter. Here's our statement, but it's not anywhere near the amount of disclosures and stuff like that you need in a REIT every single quarter, updated ongoing. So those are kind of the main differences.
So like how like a private equity is like a GP and then the fund itself is the limited partnership. That's not the good case for like a REIT, right? The REIT is just like one company. It's not like the GPs is a privately owned company and the REIT can go public or anything like that, right?
Yeah, that's my understanding. So with a real estate investment fund or a private equity fund, or a hedge fund even, they're typically GPLP structures. There's other ways to do it as well. Yeah, a REIT. Actually, I personally, I'll tell you when I don't know something. I don't know the actual structures of REITs, the internals, how they're set up.
I got you.
It's an LLC or an S corp or an Inc or whatever. I don't know how REITs do it.
Okay.
So. But yeah, it's not the same. It's much different though. Yeah.
So I know you're all about funds. Is there any negatives when it comes to funds?
Yeah, the negatives are, you got to play big boy ball now. Like it's like when you start a fund, like it's serious. Like you can't, like when you do a fund, like you're in charge of managing, investors' money for the long term, right? And it's a responsibility. It's a much easier to do just transaction by transaction basis, right? Just, hey, we're going to flip one house. There we go. Right. There's our house flip. We're done. I can stop at any time. A lot of times funds, investors are investing with you for 3, 5, 7, 10 years sometimes. And that's a responsibility, a weight that you hold to play in the big leagues. Right. The other, I guess downside would be, I guess it's just it's more responsibility, right? It's a bigger responsibility. But I think, everything plays in. You got to deploy capital. You got to be always doing new deals, getting new projects, all that kind of stuff. And so you're just playing. You're not at a scaled point. So there are downsides to scaling because there's more responsibility. But at the same time, you get economies of scale. You can hire out more people. You can delegate better. There's a lot of pros that come out of that too, as well. But yeah, I would say the biggest thing, you got to be ready to play. Play in the big leagues.
So, like you said, one of the biggest difference between syndications and fund is like a fund, you raise money one time. A syndication, you have to raise money every time. So let's say that you choose like 3 properties to buy out of your fund. Let's say you buy those 3 properties and you want to scale that. How does that work to like scaling your fund? And then you got to go back and start raising more money and buying more deals? Like, how does that process work?
Yeah. So in your example, you're saying the 3 properties we deployed all of our money. We bought the 3 properties, but now we're out of money essentially.
Yeah. Now you just want to keep buying and scaling. So you find maybe 4 more properties.
You can decide. That's the best thing about funds. You write the Bible. So you can do, one option would be you sell those properties and keep rolling them into new properties. That'd be an open-ended rolling fund. That's usually less common. The more common way is you launch another fund. So you say our fund 1, Bridger and Tyler and Emily, fund 1, we raised $8 million and we bought these 3 properties. Okay, now we're going to raise fund 2 and we're going to raise $35 million to go buy 10 properties. And you raise that fund, and then that fund launches. And about 18 months later, you'll launch fund 3, and we're going to raise $135 million for fund 3, right? That's typically the ongoing structure as you launch more. You just launch multiple funds.
Okay, I got you. Yeah. So it's better just to like almost like start, like, let's say you buy 3, create a new fund, buy a couple more, not just like start raising more money within that fund that you just originally made.
Yeah. We're talking like there's a close-ended model versus an open-ended model. So there are funds, again, you can decide if you want to do an open-ended model, you can keep raising money to that same fund and investors can move in and out of that fund. It's an open-ended model. A lot of hedge funds do that. So hedge funds will start at whatever level and they'll slowly raise money as an open-ended fund. Typically, real estate funds are close-ended. They'll say, hey, we're a 8-year fund. You put money in day 1. We'll start deploying year 2, 3, and 4. We'll be buying properties. Year 5, 6, and 7, we'll be selling all these properties. And then you'll get paid out.
Gotcha.
After, and so you're raising money the first year. After that first year, and you're deploying money that first couple of years, then you'll launch fund 2. Okay, we're fully deployed in fund 1. Now we're going to launch fund 2. And typically, fund 2 is oftentimes, 5 to 10 times bigger than fund 1, right? And now, okay, we did 15 properties in fund 1. Now we're looking to do, 30, 40, 50, 60 properties in fund 2, right? And you can grow from that. Again, you can decide though, however you want to do it. If you want to just do 3 properties at a time, that's totally cool. You can do that. Again, you get to write the Bible, you decide, but that's the typical structure that we see with investment funds. So one of my mentors, they have over 110 funds right now.
Oh, wow.
Wow.
Stacked and different asset classes, different verticals, all that kind of stuff.
So what's your goal? Like I know that right now you're creating your 2 funds. You have your course. You're really helping people start their funds. What really motivates you to, I guess, give back and help people?
My goal, I want to be a race car driver here pretty soon. Actually, that's legit. Actually, I'm getting the job. But
Is this just to meet people for your fund, or do you actually want to race?
I love racing cars. Yeah, I want to go buy a car and join GT3 like America. Like that'd be so fun. But it's about $1 million a year to do it, so I need a little more yen to get there. But yeah, for my funds, just goals. I want to manage over $1 billion. That's my first, big kind of goal is I want to have $1 billion fund, which would be great. That'd be awesome. I want to get there as quickly as I can. Internally, I have my time dates that I want to get there. Secondly, with investment fund seekers and teaching people, really that business for me is like almost a passion. Like I love coaching and helping and doing podcasts like this. I think it's really fun. I have a really good time doing it. I like bringing funds to the masses. I like letting people know about this kind of secret world of funds. I love my 2 kind of passions in life that I've found. I love, like I said, race car driving is my new one. But secondly, I really, for years, I love speaking. I love public speaking. I love, I love speakers. It sounds cliche, but like my dream job is like being a motivational speaker for high school students, like to get off drugs or something. Like, it's so fun. Cool. So this is a great way though for me. I still like fulfills this side of me of like, I love contributing. I feel this calling to like give back. I feel this calling to like help other people on this same journey and share. I understand the uniqueness of my position. I have a dad who's running, now retired, but ran deca-billion-dollar funds, a brother who's, security attorney. Like, I couldn't have been born into a better spot. So I might as well share what I've got, and share what, with the rest of the world. And so I feel a huge calling to do that.
Yeah. And there's really not that many people out there really doing it. Not like kind of like how you're doing it. They're either doing syndications.
Like nobody. There's like nobody. Like go find, there's maybe like 2 or 3 people trying to teach about like really no one does this. And it's kind of sad that and that's why I wanted to start. I was like, okay, there's no content here. Let's make the content. Let's help people do this. And it's been fun. We just hit over 10,000 people in our stuff, in our programs and courses and stuff that we've from any degree. And it's been really fun. It's been fun to be a part of it.
Very cool.
Yeah. And all those, the bots that keep copying you, they're trying to do it too. So
I know, dude, I've got about 10 scammer Instagram accounts right now. If you guys
I've had 3 like follow me within the last probably 3 days.
Dude, they're ridiculous. And Instagram does nothing about them. Like we report them. Like we hired a spam like agency that apparently does this and like takes them down. And anyways, it's insane. We're trying to get and Instagram won't verify you. They don't care. Like it's just funny. Yeah. They don't care at all. So anyways, don't get scammed if you listen to Bridger_Pennington is my official Instagram. Okay. Bridger_Pennington. Don't listen and I won't DM you asking you to invest into crypto. I promise. Yeah. So there you go.
Well, I guess on that note, where else can people find you other than your Instagram? Yeah,
I mentioned Instagram. Great spot is YouTube, Bridger Pennington. Actually, for your guys' listeners, you guys want, we created a free course on funds. We put together 30, 40 videos, downloadable stuff, and it's 100% free. I promise. It's like you put your name and email in, and I think that's it. You hop in. And so if you want that, it's investmentfundsecrets.com/free gift. So again, it's 100% free. My goal of that course, by the way, is number 1, to just help people understand funds. Number 2, I want to knock your socks off. I want to help, we try to give a ton of value in there so that if you want to in the future, we do coaching and we have events and other stuff. If you want to, you'll get a ton. I believe in giving value up front. I believe in paying it forward. And that's the idea. That's me being transparent. So don't believe, we're not going to spam you with all of our, it's me trying to pay it forward and you're going wow, this guy's legit and he's got a lot of good content. I want to, come and join their Facebook group or come to their event or come hang out or come do coach, whatever it is, right? Or we can help you launch your fund or whatever it is. So again, investmentfundsecrets.com/free gift. You guys can head over there and grab a free course on funds.
Awesome.
Yeah, that's where I found you on YouTube and then I went through your free course and then I was like, man, I really got to get this guy on the podcast. Yeah, so I'm really glad that we were able to get you on and learn even more about the unkept secret no one really ever talks about. So
see, that's the benefit of the free course. I get to hang out with you guys. That's awesome. That's why we do it. So, yeah.
Very cool.
But